Not a chance. I think Merrill's probably wrong both for macro reasons and micro reasons. Quickly, on the macro side, you can still find companies that are generating sufficient free cash flow and free cash flow yield that makes stocks a compelling opportunity. Valuations are compelling. Sentiment is not too robust. Bulls and bears are about equal in their numbers. And then last, we're only about 130% above the prior peak of October of 2007. So 11 years from the prior peak, we're not much above it. So I think the bull market still has some strong legs left in it. Certainly not at the same pace, but in an environment where stocks are still the preferred asset class and individual names like Unisys or Broadcom or Qrate, which is the parent for QVC, they all represent on a micro basis opportunities to be a buyer in.
Jason, what do you think? I mean, there's certainly risks to come. We don't exactly know how all of this trade war is going to settle out for the market. The Fed is expected to continue raising rates, but I don't know. I think economic growth looks actually pretty good despite everything that we may be worried about. So what do you think, Jason? More room to run here, or should we be a little cautious going forward into the rest of the year?
More room to run. You make a great point. You know, I haven't read the note, so to be fair. But we at AssetMark would say that there's plenty of room to run. There's certainly room for different strategies, whether you're looking to be aggressive or a little more defensive with a tactical strategy. But to me, you could name 10 reasons right off the top of your head to invest in this market, but you only need 3 of them. It's economic growth, it's profitability, which is growing across the economy, and it's low volatility, which has typically been associated with higher than average returns. And importantly, what it means is if you get the timing a little bit wrong, the danger of significant losses is lower. You know, I'll sum it up and say it doesn't get much better than this from the standpoint of an equity investor.
And that's why a lot of people are worried, Jason. I mean, the markets, by all of the sort of standard measures, haven't really had a blowout year. The NASDAQ is up about 15%. The S&P maybe about half that, and the Dow maybe a little less. None of them, some are close to their all-time highs, but none have broken through in recent months. But there is an awful lot of consensus that this can just go on and on and on, and the market can just keep simmering, keep boiling, and don't worry about it.
Yeah, that's so interesting. I mean, our clients range from Main Street to multi-generational wealthy families, and they all seem to have a concern. It may be a little bit different whether it's focused on trade or interest rates or other issues, but there is not a kind of euphoria. You haven't seen the kind of fear of missing out and greed that you normally see marks the beginning of the end of a bull market. Everybody's just concerned. You look at the asset allocations across the board, they're by and large defensive, even though we're just now starting to get a reasonable level of interest rate.
And that David, seems to me, in part, what Jason's just describing there seems to me in part to derive from the fact that American investors have been here before and gotten their ass handed to them.
They have, Tyler, when they've paid near perfection valuations for stocks that don't exist today. I think there's more trouble in the bond market, frankly, in many respects than there is in the stock market. And then dovetail with my guest, institutional money that I manage or institutional investment committees that I get to sit on may expect that stocks can return 6%, but they're going to find a good active manager that's going to generate 7% or better rates of return. And where else are you going to get that? It's more tempered, but it's still a case where you're going to get mid to high single digit returns over the next 2 or 3 years. That says there's more to go.